So let me formally welcome you to today's event. I'm really excited to be sharing with you the key proposals in the second exposure draft of INPAG, International Non-Profit Accounting Guidance, and the whole point is so that you can give us your feedback. My name is Samantha Musoke. I'm the IFR for MPO Project Director for Humentum. I'm based in Uganda, and many of you have received an invitation or an email from me. So thank you so much for coming today. Today, I'm delighted to be joined by Paul Mason, who is a CIPFA Associate, and that's the Chartered Institute of Public Finance and Accountancy. Paul has taken a lead role in drafting the content of the section that we're covering today. So he's exactly the right person to answer our questions and also just add colour and context in terms of the process of the decisions that have been made. So welcome, Paul. We also have Philip and Nandita from CIPFA and Brian joining us from Humentum as well. So you're all very welcome. Now, hopefully, many of you have attended earlier events, so you have some awareness about IFR for MPO and INPAG. So we're not going to introduce the project and the exposure draft to in each of these webinars, but there are some other videos that give you a background to the project and a background to ED2 in general, available on our YouTube channel and on the event link, on the event page on our website. So today's event is part of a series covering the main themes in Exposure Draft 2, and I know that many of you who are here have been with us throughout the month. You can register for future events, and you can also receive the resources from previous events from the website. It does take us a couple of days to get that up, but you will be able to find resources from previous events from the website. We really are keen to hear your thoughts and feedback. I'm not just saying that, we really are. It really matters and it makes a difference. The perspective of people working in the sector, donors, auditors, accounting profession in the world, around the world, are really essential to making sure this guidance is relevant, it's user-friendly, it's credible, it's fit for purpose, and so that it can be widely adopted. You probably know that the project started back in 2019, and we have had input from various experts and advisors to reach the point of having the second exposure draft to share with you. Now, the purpose of today's 1-hour webinar is to explain those proposals, and so that you can have the opportunity to ask questions, seek clarifications, as well as share your comments, opinion, and feedback. At the end of the webinar, we will tell you how to submit a formal response to the consultation so that you can share your views. You've got until March, so there's time to get familiar, to ask questions, have debate, and really have a rich conversation as a sector about what will work for us. So here's the flow for today's session. We've already finished the introduction, that's done. And now we're going to do something a bit unusual for a webinar, but normal if you've been following this series. We're going to watch a video in YouTube that we've prepared in advance to explain the proposals. This one's a fairly short, it's like 8 or 9 minutes, depending on the language. So we're shortly going to share a link in the chat. Sorry about the noise. We're going to share a link to a playlist that has the same video in English, French, and Spanish. And this way, everyone can watch it in their preferred language. In case you get YouTube adverts, please just click through them. Just to say, as a project, they're not linked to us, and we don't specifically endorse anything that any adverts that you might see while watching the video. So hopefully that's in the chat now. You put that in the chat, Brian? Great, there's the link to the videos. So as you're watching the video, please think about how the proposals apply in situations that you're familiar with, in your context, so the NPOs that you're familiar with. Please do type any questions that come to mind in the Q&A in Zoom, or you can type them in the translator app if you want to type them in another language other than English. After the video is finished, please let us know in the Zoom chat. You can say I've done and finished, and we will come back together and have a shared Q&A. Because of this event, the size, the language considerations, we will only take questions in writing. So for now, let's each go to Zoom and watch the video and see you back here shortly. Welcome back from watching the video. I hope you found that thought-provoking and interesting and informative. And now we've got a chance to look at some questions. So thank you to those of you who have put questions in the chat already. Just before we get to the questions, I'd love us to do a quick poll that will sort of be a bit of a temperature check. And I'm going to relaunch the poll here. Okay, so you should see that on your screen now. So the first question is, how important is information about donations in kind for transparency and comparability? Very quite not important, useful, but not worth the effort. And the second question is, how big a change would it be for NPOs to track and recognize or disclose donations in kind? So there you're thinking about NPOs that you're familiar with. Would this be a major change from what people do now or not? Great, so I can see 72% of people have responded. So that's super. I'll just leave it open for a little bit longer, but what I'm seeing so far is 72% of you think that it really is important, very important, 19% quite important, and 7% saying it is useful, but actually it's not worth the accounting effort. So what I'll do now is just end this and share the results so that you can all see them. So you can see the results there to the first one. So a pretty good consensus so that it is important, it is valuable. The second question, how much of a change would this be? So the biggest answer is 48% of people saying this would be a significant change to start recognizing, disclosing donations in kind. 26% saying this would be a major change, really big change from what's happening at the moment. 19% saying it's a minor change, and just 7% saying they're not sure. So that's really interesting. So we've got, yes, it's important, but obviously it would be quite a big change from what people are used to doing at present. And I think that's, share results. I thought I was sharing results. Did you see the results? Hopefully, there we go. I'll just share them again very briefly so you can see them. Close it. Okay, so let's get to some of these questions. So the first question is from David in Australia, which is about this is about the fair value. And so Paul, I'm addressing this to you, and you can see the question as well. So in Australia, there is a filter, and the filter and depending on the answer to the filter is when you have to work out the difference between the fair value and a purchase price and recognize a gain. And that filter is where the consideration for the asset is significantly less than fair value, and that is principally to enable the entity to further its objectives. So where basically you have a donation, an asset being given well below its fair value, you don't have to recognize a gain. So how does that sort of resonate, Paul, with what we've got in INPAG?
I think when we're looking at the donations, we're looking at things that have been given without any charge, but applying the principles, if you receive assets and you pay less than their fair value, then yes, you would be INPAG would require you to recognise that difference as a gain. There isn't a filter in terms of whether it's significantly lower or not in INPAG. However, what you could do is apply materiality. So if it's lower, if the amount that you've paid is lower than the fair value, but not materially so, judged against the entity as a whole, then you could not recognise any gains on that because it wouldn't materially affect the financial statement. So you can bring materiality in there. In terms of it avoids you having to work out what the fair value is. Well, to an extent, you still have to have some idea of fair value to know whether you're significantly lower or not. Probably don't have to be as precise, but you still have to sort of make some estimate of fair value to be able to make that assessment. But yeah, we are going to be looking at the fair value guidance in Exposure Draft 3, and there will be some guidance added to what's in IFRS for SMEs on assessing fair value for donations. So we haven't started work on that yet, so too early to say what is going to be in that guidance, but that is something that potentially could be looked at that point.
Thank you, Paul. So if I've got this right, in INPAG, mostly you do recognise a gift in kind. And David's question is if you are paying for it, it's not an outright gift.
Yeah.
So you would have to recognise the difference between what you've paid for it and its value. But what INPAG mostly talks about is just when you're getting a gift and you have to work out what value to put in. Okay, that's really helpful. So that was about gifts. There's another question about services in kind. So in INPAG, we have this idea of critical, mission critical and not critical. And David says that in Australia, he likes the fact that they've got the services would have to be purchased if they hadn't been donated. And that's something that I think that happens in some other jurisdictions as well. So why did we go for critical, non-critical, rather than would have had to buy it if we hadn't been donated it?
Yeah, that's something that the technical advisory group did discuss. In fact, some of the earlier drafts of this section before we got to the final approved version for the exposure draft did include that split based on whether it would be purchased or not. I think in the end, tag view was that there is still a degree of subjectivity there as to what would be purchased or not. But also for a number of NPOs, the services they purchase are actually not the ones that are critical to their mission. So a number of NPOs purchase or would purchase things like accountancy services, audit services, but not necessarily the volunteers who are providing the services to the beneficiaries, to the service recipients. So the example in the video is of a NPO that's providing counselling services. Almost all of the those telephone counsellors are volunteers. Generally, the NPO is not in a position to pay to purchase those because it doesn't have the funds to do so. But it may otherwise, it might need to purchase the accounting and audit services or legal services because without those it couldn't operate. But those really are just administrative services and don't really tell you a lot about the operation of the NPO. So on balance, agreed, probably is easier to determine what would be purchased rather than maybe easier than what's mission critical. But that mission critical is viewed as being more transparent, tells you more about the nature of the organisation, tells you more about the risks it faces if it can't have sufficient volunteers, because without those telephone volunteers, that charity in the video wouldn't be able to operate. We know from the responses to the consultation paper, one NPO was mentioned that runs a similar sort of counselling service and actually discloses its estimate of what the cost of the volunteers would be. And that cost would have been 4 times its, I think it's 4 times its annual income. So it would have to increase its income by 400% if it was to purchase those. And that's useful information because that tells you how much that NPO relies on its volunteers as opposed to the people it's able to pay.
Interesting. Okay, so it's really almost recognizing the sort of superpower that NPOs have of being able to bring in volunteers that are actually really central to its existence, not peripheral, but really essential to its existence. I also find it very interesting that administrative services like us accountants and lawyers and whatnot aren't deemed to be mission critical. I'll try not to take that personally. So the focus is on the front line, if you like, the missional services and the services in kind, or the gifts in kind that are, or the services in kind here that are being used to deliver that mission. Okay, thank you. So maybe I'll go back to just building on the earlier question about fair value. So what does it mean for a donation in kind to be measured at fair value? David obviously knows, he's referring to it, but for I know it's a question on the lips of others. What does it mean, fair value? And what does it mean in a non-profit context where we don't have markets and things might be different value to different people? What does it mean in our context?
So generally fair value means what you would what you could sell something for. So if you receive goods, you know, what's the selling price of those goods? And typically, for a lot of things that NPOs receive, there will be standard prices, you know, something you could go out and buy in the shops, something you could just buy from suppliers, and there will be a price that you could, you'd know what you would buy those for, so you could use that price. For other services, that will be more difficult because there isn't, it isn't something you can easily go out and buy. So for the volunteer services, yeah, you're going to have to, there's going to need to be an estimate made of, well, how much, if we did have to employ these people directly, how much would we have to pay for that? And so you're looking then at, well, what's the local labour market like? What skills are we using? How much would we have to pay? We haven't got the detailed guidance on that. That's going to be coming in Exposure Draft 3. But it is going to be a question of, well, if we had to do this ourselves rather than relying on volunteers, what would the cost be? Is going to be the sort of underlying principle. And there is some guidance on this type of issue in other standards. So not necessarily directly linked to fair value, which is generally seen as what would the market pay for this, which may not be the same as an NPO. But we may want to look at what the IPSASB has recently done on its measurement standard, which looks at sort of value we need, sort of current operational value, how much would it cost for its current use. So there is some guidance that we may be able to draw on when that fair value guidance is being developed. But as I say, we haven't started work on that yet. So what ends up in that will depend on the discussions at the TAG, at the PAG, and amongst sort of the people developing that section.
Okay, thank you. And I can see Jose put Leslie put a comment in the chat about the resources needed to track and value donations in kind. So you've got the tracking of the quantity, if you like if it's people, how many days, but then you've also got this question of how do you value a day? I know we had this even at the IFR for NPO project at the very beginning, when we've got loads of volunteers on the practitioner advisory group and the technical advisory group. They're giving their time and they're mission critical to our project. So we're valuing them in Humentum's financial statements, and we had to pick an amount, and it's very difficult. You've got people from all over the world with different market rates, but in the end we picked a number and went with it, and are consistent, and it means we've got something to show that we are dependent on these volunteers. So great. So that's a question here from Jose. Greetings to all. In the case of a donation for your own use, so an NPO is receiving something that it's going to use itself, subject to recognition as income until its use. So there's this exception that instead of recognizing it when you receive it, you can recognize it when you use it. It's not clear to me whether I should recognize a liability or as part of another account until the time I recognize the income. So what happens in that time between when I've received it and when I recognize it?
In accounting terms, nothing happens. So there's no recognition of revenue, no recognition of any assets or inventory. And that's because a number of items that NPOs receive in this way actually never get used by the NPO. So if we were to recognize the asset, the inventory, and then the NPO found it couldn't use it, which may very well happen if it's perishable items with short dates, which something that NPOs are often given, then you would be recognizing revenue when you received it, and then recognizing the asset when you received it, and then having to impair the asset back to zero when you can't use it. So you'd have a revenue and an expense for something that you've not been able to use. So we're giving, the INPAG is proposing that actually that's a permitted exception. You don't have to recognize that item when you receive it. You just don't do anything at that point. And then when you use it, at that point, you know that, okay, we've got value from that. We can recognize revenue for its for the receipt at that point and recognize an expense for its use. So revenue and expense at that point will match, but you're only doing that for items that you've actually been able to use. It saves the issue about having to recognize inventory and a liability for things that you've received but not yet been able to use, with the risk that you then have to write off the asset as well because it goes out of date or something like that, or it's not suitable for the NPO.
So that'd be a great relief, but you do have to track it. So even if you haven't recognized it or valued it, you'd have to know that you've got it so that when it is used, you can actually do the accounting. So it's not nothing, it's just not being recognized, it's not necessarily being valued. You just need to know that you've got it, and then when you use it, you can do the accounting. So hopefully that's a good simplification. I'd be really interested to hear your thoughts on whether these exceptions are things that you would use and find helpful. Okay, I've got a question here from Charles Gachuhi. Yes, if I've said that right. Would the supply of goods at a cost significantly below market price be considered a donation in kind? For example, I'm an NPO, I've received laptops at a price of $1,000, but their actual market price is $2,100. And I've got this difference between fair value, market value, and what I've paid for that. Would that be recognized? Do I have to do that top up and recognize it as a donation in kind?
Yeah, I think it would be. I think we would be expecting there to be some recognition of that revenue. I think we talk about sort of effectively treating it as two separate transactions. So effectively, you're paying for the laptop, and then you're receiving top up of effectively of a grant for the difference between them. So effectively, yes, you would be sort of showing the laptop at its fair value, recognizing the payment that you've made, but also then revenue for the difference between the two.
And then would you be depreciating the full 2,100?
Yeah.
Okay, so your balance sheet would show that asset as at its fair value, even though you hadn't paid for it.
Yes.
Okay, interesting. So that could have quite an impact in those years. Fortunately, laptops don't last that long, but that could have more of an implication for very long-lasting, high-value assets. Okay.
Yeah.
Thank you. Rafikul in Bangladesh says, an in-kind donation is a non-cash contribution. That's right. These contributions can be made in the form of time, services, expertise, goods, or items. In the case of items, sometimes we face problems to cover insurance because the organization has the policy, but the donor hasn't given the purchase documents. And the resulting insurance company can't provide any insurance. So I guess it's linked to, in accounting terms, it's linked to this measurement and ascribing value. And if we're plucking these values out of the sky because we don't have documents, it's not only an accounting issue, it's a very pragmatic, practical risk that we can't insure things. Do you have anything to say to that? And if anybody else has experienced this and has an advice, you can also add it in the.
Yeah, I don't think that's anything we can really deal with in the accounting side of things, other than to say, well, at least if you may not have insurance for them, but at least if they, if you haven't used it and it gets damaged, well, at least you're not going to have to recognise a loss if you've taken advantage of the exception and not recognising the items until they're used. So at least you won't have anything going through the accounts for the loss of that. But it's more of a management issue, and it's something where, again, working with the donors so that you do get the proper documentation so that you can have the insurance is sort of ideally what you'll be looking for there. Now, to the extent that you need to sort of think about how that plays into the relationships with the donors, also how that what is the value of the items and whether it's worth the administrative costs, the insurance costs of actually getting that. But yes, if it's sort of items that do have significant value, sort of just whether it's just because of price or for volume, then the best way of dealing with that is working with the donors to actually get some documentation of what the value is that is going to be appropriate to share with the insurers. Also, getting that documentation may then help you in terms of determining the fair value when you do use it, because you will actually have the information about what the donor has paid for those items, which is something that you could therefore use to determine fair value.
Yeah, it's a tricky one. Sometimes donors don't want to share the value, or they don't know, and it's secondhand, and it's fraught with problems. I am familiar with an NPO in Uganda that receives secondhand musical instruments. They're really valuable, but they're secondhand. How much were they worth? I mean, it's really difficult, and we have that insurance challenge. One thing I do wonder, and maybe I'm thinking aloud here, is insurance companies are used to dealing with for-profit businesses, and they don't get donations in kind in their world. Why isn't there a document? There's always a document. It's such a norm. And hopefully having something like INPAG with this guidance around valuing items, maybe it'll be a way to persuade your insurers to take your values, but without requiring documents. But anyway, as you say, that's not really a problem that we in the standard setting community can solve. But thank you for sharing that practical dilemma. Jose has sent a follow-up question. So Jose's question was about these items that were received but not recognized. We've noted them, but we're not going to recognize them until we use them. Do we have to at least disclose that? If the year end comes, we've received the items, but we haven't recognized them, do we have to make disclosures about that?
Yeah, I think it was in the video, there is a disclosure requirement that where you've taken advantage of one of the exceptions, then you do make disclosures about that. So a description of the type of items that you've received and what what the planning to do with those items is. So it's not going to be hopefully not particularly onerous in terms of having to give lots of detail. But yes, the fact just to let people know that yes, we will have received items. We haven't necessarily recognized everything yet because we haven't used it all. There would be that type of disclosure, sort of noting what type of items are received, explaining how it's generally used in the NPO.
Yeah, I think it's fair to say there's quite a strong leaning towards transparency, isn't there? So if measurement there's an exception that you don't have to measure or you can't measure for whatever reason, at least disclose. So let's make sure that there's as much transparency as practical and as possible, to give users a sense of really what the organization is receiving, how dependent it is, and so we get more comparability. So thank you for that, Jose, that's really helpful. So Moo has asked a question here. Actually, I want to ask another one which is linked, and then I'll come to Moo's question. So if there is the option to take an exception, so in the guidance that things like as you say, items that aren't used yet, and we take that that exception is there as an option. Do we have to take the exception? Do we have to not recognize, or could we choose to recognize anyway, even though we don't have to?
Yeah,
is it choice or mandated?
They're permitted exceptions, so you don't have to take the exceptions. you can recognise everything if you choose to do so. Recognising is going to give more transparency, more accurate information in the financial statements. So in that respect, it's preferred, but we do appreciate that there's quite a lot of cost associated with doing that. For some NPOs, it will be challenging to get the fair values, and the benefit that users of the financial statements will get from that information doesn't outweigh that cost, which is why the exceptions are there, but they are permitted exceptions, they're not required. So if you choose to recognise the items, that's absolutely fine. And what NPO says is you can make that decision on a class by class of inventories. So there may be some inventories you say too difficult, we're not going to recognise that, we'll use the exception for that class of inventories. But for this other class where the market values are easy, so you may be getting, say, donated stationery where it's clear, easily prices are easily accessible. You could do that. We'll recognise that as it comes in. Everything else will only recognise as we use it. So it's by class of inventory, and it is a choice for the NPO as to whether it uses those exceptions or not.
Brilliant. So we're trying to be really pragmatic and real world, with a bent towards transparency, but recognizing that the cost might not always be worth it. So hence the exceptions. That's really helpful. Thank you. So let's come to Moo's question here. So a vehicle provided by the donor to use it for project objective, but the ownership is in the name of the donor. So let's imagine, I don't know, a van or a 4-cabin car or something that's used for project purposes. The logbook, the registration is in the name of the donor. Is that a donation in kind? Does it actually get recognized in the books if it's used by the NPO, but it's legally registered by the donor? And then how do you value it? You didn't buy it. You might not have the documents again. Could you do it on a daily rental rate, like a vehicle rate in the market? Like you've got use of the vehicle, therefore you value it at that? Or do you try and get the use of the assets, the value of the asset, and recognize it as a PPE, as equipment and property? Great question.
Yeah, so general principles, you recognize items that you control. So the question is, what actually do you control in this case? And that will depend really on what happens to the vehicle after the end of the project. So if at the end of the project, the NPO is allowed to keep the vehicle for its own use, then effectively, even though it may not have the legal title at the moment, that is going to be effectively a donation of the vehicle. And the best way to value that would be to look at, well, what would it cost me to buy an equivalent vehicle in the market if you haven't got the documentation from the donor. If it is at the end of the project, that vehicle goes back to the donor, then yes, effectively what you're being given is the use of that vehicle. So looking at a daily rental rate and using that as your the amount that you would recognize as the donation in a year. How much would it have cost me to lease or to rent that vehicle for the year is probably an appropriate way to do that. Probably worth looking at what the, if you've got it for, say, a 5-year project, looking at what the long-term rental rates would be rather than just a daily rental. But yes, looking at what that sort of rate would be for a year or something like that. But it will come, what you're recognizing depends on what you're actually being given. Is it the right to use that vehicle for the life of the project, or is it the vehicle but with a requirement that you use it for that project while that project is active?
So it gets complicated, because I know in certain, like USAID agreements, for example, they'll say at the end of it, you've got to give it back, but if we don't have another use for it, you might get to keep it, or you might get the option to buy it, or we might give it to another one of our projects. As in, there's this unknown end of project outcome, which might result in you being given it, might result in you buying it, might result in somebody else getting it. So when that is contingent on various future outcomes, and it's ultimately up to the decision of the donor, how can your current accounting be dependent on what will happen at the end of the project? What should you do? Just make a best guess? Or
you've got to say, is it, if you're looking at, say, the leasing requirements, you would be looking, which isn't something we've specifically looked at in this phase of INPAG, but and we are bringing in the leasing requirements for IFRS for SMEs, then you would effectively, is it more, when you're looking at retention of vehicles after the lease period, you would treat it as, is it the circumstances make it very likely that the NPO would get to keep the vehicle? If it's a donor choice, it isn't going to be very, it's not going to hit that very likely criteria. So you would say, okay, we'll treat it as a donation for the period of the project, just the use of the vehicle for the period of the project. And if you then get to keep it, then that's treated as a separate donation of a second-hand vehicle.
Okay, super. So yeah, we've got to make some judgment calls about future likelihood and account accordingly. Super. Yeah. So another thing that came up in the video, and I know one of the things the video says is, before you watch this one, please watch these other ones on revenue recognition. So for those of you that have come to this one in isolation, I hope that wasn't too difficult, but it refers to the fact that the exceptions for account recognizing donations in kind only relate to gifts that are given in the context of an OFA, an other funding and agreement. You can't take advantage of any of these exceptions if they're given in the context of an EGA, an enforceable grant agreement. Why is that? Why, if the exceptions have value and are worthwhile from a cost-benefit point of view in an OFA environment, why doesn't the same count for if they're given as part of an enforceable grant agreement? And maybe can you put some examples in, I think, to help bring all this this terminology to life?
So in an enforceable grant arrangement, these are the grant arrangements where the donor says, we will give you X amount of cash, but in order to be entitled to that cash, you have to carry out these activities or meet these objectives. And where you're looking at donations in kind as well, it's we will give you this amount of cash and this vehicle to carry out this objective, to meet, carry out these activities, meet this objective, and that's sort of the requirement. When you get into that and you start carrying out the activities, you recognize effectively an asset for any work that you've done towards that, but you also recognize a liability for anything that you've received, and you recognize revenue only when you meet the objectives or satisfy the criteria in the grant. And you do that by de-recognizing the liability where you've received things in advance and recognizing revenue. If you haven't recognized the asset, so you've received the vehicle, haven't recognized anything for it, use of a vehicle rather than the PP, rather than as PPE, you've received that use of the vehicle, but you haven't recognized anything for it, then you can't have done debit asset credit liability. So when you come to recognize the revenue, your liability is then going to understate what you have to do, and you're then not going to be able to recognize the full revenue for that agreement by de-recognizing the liability. So because EFA is more complex, can lead to recognition of a liability, which is an obligation on the NPO to carry out work, which is going to have costs associated with it. Not recognizing donated assets, donated items as part of that grant that's given will distort how that model works.
Interesting. I think this is quite interesting. So if a vehicle is given to do certain outcomes, objectives, the enforceable grant obligations. So say you've got a vehicle and it's going to achieve many different outputs or outcomes, and I think this is quite a complicated area. I think you've asked a very interesting question there, and we'll have to maybe we'll put down some examples in writing as well in relation to that. It's really good questions. So I think great questions that have really showed that everybody's really thinking about this in practical terms and how this is going to look and how it's going to work. I'm very sorry about the noise in the background here, but let me take a few final minutes to share how to share your response. So this is really exploring the proposals, discussing with each other. We've got until March to make a formal response to this public consultation. And I should say, I think Brian's going to put a link in the chat now. If you are considering submitting a formal response, please do fill out this short form to let us know, and we can support you in that as needed and make sure you get access to all the things that we hope to help you find them. To actually submit a response, go to the website, Have Your Say. Step 1, there's a template response document that you can download. You can input your own simple details and save it. Have it on your desktop. And then over the coming weeks and months, form your opinions on the proposals. You can watch the videos, read the documents, come to webinars like this, participate in the outreach events, which we'll have in February. And as you go along, record your thoughts into the template. It's structured in order of the sections of INPAG. You don't have to answer everything. And there's a question at the end, which is a catch-all if you've got anything else to say. So if you don't find a specific question or section that kind of addresses what you want to share, there's space for that too. And then you upload it via the website. As you probably know, we're in Exposure Draft 2 at the moment. Exposure Draft 3, which will include things like fair value, fund accounting, classification of expenses, that will be coming out in Q2 next year. And we're still on track, hopefully, to issue final guidance ready for adoption in 2025. So with that, let me say a huge thank you to all of you. Keep this conversation alive. We'll want to keep hearing from you and you being able to talk with each other and hear from each other and formulate those opinions as a community. Thank you very much. And thank you, Paul, for dodging or managing all the things I've lobbed at you in this webinar ably. We really appreciate all your time and effort in this. All right, thank you so much, everybody. See you tomorrow for inventory, hopefully. Please do sign up. We'll see you later. Bye-bye.
Bye.